Welcome, QS2 Associates. I want to thank you for attending today's training. We're excited about what we have today. Always excited about our Wednesdays because it focuses on the products you need to be educated on so you can really sell and make sure you know the power of the products with our core product providers and our preferred product providers such as American General today. So to introduce our guest and also to make sure that we're off and running in the right way, we have our Executive Vice President of Sales, and that is Mike Gunzig. Mike, welcome to the program today.
Hey, thanks, Randy. Glad to be here. Hello, QS2 Nation. Well, today for our training, we have Tor Butterfield with American General. American General is one of our top partners for life insurance, and really the reason why is that they have really great products. They've got great sales tools, and Tor's going to go into some details about the products and also the sales tools they offer. And another thing we really like about American General is that their products are available, or almost all their products are available throughout the U.S., including New York. So with that, how you doing, Tor?
Doing great, Mike. Thanks for the warm up and the introduction.
Excellent. So I'll let you go ahead and go through the presentation.
Okay, sounds good. Well, we'll dive in. Like Mike said, what we'll cover today are basically a high-level overview of the key protection products that American General offers, as well as for United States Life, which is our carrier name in the state of New York. Then we'll give you a snapshot of some of the tools we have, specifically Rapid Rater and also our online application, the AIG Quick Ticket. And finally, we'll talk a little bit about our best accumulation products, show you a little more with those more advanced products. To get started, I'd like to give a shout out to One Resource Group. One Resource Group is the partner that we work with for back office support for QS2, and we couldn't do it without One Resource Group. So I definitely want to plug One Resource Group before we get started. So diving right in, we want to show you some product details and also show you the tools. So I think one of the best things to show you is a online option. You can get to this via the web. You can get to it on your iPhone or on your Droid if you have a handheld phone and you want to carry that out to a meeting. Get some quick quotes. And the way to do it is you go out, if you're in front of a computer, you can Google this, Rapid and Rater. Those are two words. Put them into Google, and the first option that results is probably this Rapid Rater link. So you click on the link, you open it up, and it's just a simple way to quote our top protection products. So when we talk about protection, we're talking about term. We offer one of the best term products in the industry. It's called AIG Select-A-Term, and we just repriced it here in the last month or so to reduce premiums. So it's very competitively priced. We also offer something that not all carriers do anymore. We have a version of the product called AIG ROP Select-A-Term, meaning that it's a return of premium Select-A-Term. So the cost will be, generally speaking, double, sometimes as much as triple. However, if the client lives to the end of the duration, then they would receive all the premiums they paid back, along with a couple other options that they can choose at that time. So it's a very unique option, and we offer the return of premium Select-A-Term as well as just your regular Select-A-Term. A couple other things you can look at on the Rapid Rater is you can quote out our simple GUL product called AIG Secure Lifetime GUL. That is now its second version of the product, so it's AIG Secure Lifetime GUL with the Roman numeral 2 behind it. And also the survivorship version, which is AIG Secure Survivor GUL. Also now it's in its second edition, so it would be AIG Secure Survivor GUL 2. That'll make sure you have the premium quote that you need for your meeting, and you can get it immediately. Don't have to go into any illustration software system right there. It's web, it's on your phone, it's where you need it when you need it, 24/7. So Rapid Rater is a great tool. I hope that you'll add it as a favorite to your desktop, or go out to the App Store on your iPhone or on your Droid. You can search for this Rapid Rater by searching for 4 letters, which is AGLC. That stands for American General Life Company. So AGLC in the search will pull up that app, and it is highly rated, about 4 out of 5, which is strong. So here's what it looks like. When you put in the input, the client data, and you can put in just basic information, age, death benefit requested, the state, of course the sex of this client, and also how they want to pay, monthly, annually, or such. Hit the submit button, and what you'll find is you get a spreadsheet. The spreadsheet provides you premiums for all the different durations that we offer, but also all the rate classes, the select rate classes. So we have standard, standard plus, preferred, and preferred plus. And then along the left-hand side, you're seeing all the durations. In other words, we offer this as a 10-year term, a 15-year term, and then we have every duration between there and 30. So we have this product that offers a lot of flexibility, allows you to customize the coverage right down to whatever the client's need is, and make sure that you're giving them the most competitive price that they want. So as an example, maybe a client you meet with has a $1 million mortgage, and it's a 27-year mortgage that's remaining. Rather than selling them a 30-year term, you can walk in with a 27-year term, which of course will have a lower premium for them, and it'll help you beat any competitors that might also be talking to your client. So talking about the selected term and also the return of premium selected term product, these are products that are very well priced. So what else does someone care about when they're comparing term products out in the market? Oftentimes it's, can we convert the product? Can we convert it to a permanent plan? And the answer here at American General is yes, you can. So within the first 2 years when you're purchasing the selected term product, the client could even convert to our return of premium selected term. So that's a unique option within the first 2 years. But also during the first 5 years, they can convert to any of our single life permanent plans, and that includes the secure lifetime GUL, also our accumulation products, the IUL products, and also the hybrid product, the GUL-IUL hybrid product called AIG Choice Index GUL. Once you're beyond the 5 years of the term policy being issued, so now we're in that 6th year, we also have a couple of conversion products. One is the AIG Extend IUL, the other is the American Elite Whole Life. So moving beyond the term, I think we've talked about term in the past, and I hope everyone's comfortable with our term product. We want to talk a little more about the GUL product that we offer. Again, this is a protection product. The focus is the death benefit, right? Your client needs death benefit, but they might need death benefit guaranteed longer than a term contract will allow. So the maximum duration for our term contract for younger clients is 30 years on the term. We also offer 35 years on the ROP term. But what if your client says, I need term coverage to 100, and the client's 50 right now? Well, there's not a term policy out there that can provide that type of coverage. So that's where the guaranteed universal life insurance comes into play. And we have a great guaranteed universal life contract. It's the AIG Secure Lifetime GUL. There's also a survivorship version. So if you're sitting down with 2 clients and they want to have a joint policy, we can offer that as well through the Secure Survivor GUL. So it's very interesting. We've got very competitive pricing, and there's an incredible amount of flexibility with this product because it comes with guaranteed cash value. So while most GUL contracts in the industry might have some cash value for about 15 years, most of the GUL contracts don't offer any cash value beyond the 15th year. However, at American General, we offer a contract that does, and you don't have to pay more to get it. This is very competitively priced. You'll find it right at the top, but it comes with this additional value for your clients. So if you're the one meeting with the clients, I'd feel very strongly about bringing this product out to them because of the value that's in there. You can talk to this value, and the value is all really bent around the fact that there's guaranteed cash value that's in this contract. Some of you may have sold whole life prior to what you sell now, or maybe you still sell whole life. And with whole life insurance, as you know, the policy endows at maturity. So if it's a $100,000 whole life contract, you have $100,000 of guaranteed cash value at age 100, whenever maturity is for that whole life contract. With this GUL contract, Secure Lifetime GUL, it does the same thing when you guarantee it to maturity. So for us, maturity is age 121. And as long as you guarantee the contract all the way to 121, then if you did a $100,000 policy, it would have $100,000 of guaranteed cash at age 121. It's incredible. You won't find that with other GUL products. So the client has this guaranteed cash value, and they can use it. And I'll show you an example here in just a little bit of exactly how they can use it. Keep in mind we have rolling targets on this product outside of New York. So if the client says, let's just pull the guarantee back to 100, I'm not that worried about the guaranteed cash value. I'm really just worried about the death benefit going all the way to 100. Well, that's perfectly fine. We can just pull the guarantee back to 100 or 95 or 105, whatever that client needs. However, what's really nice is even though they're pulling back the guarantee and that reduces the premium, the target is still going to remain where it is. And because of our rolling targets, compensation is done on the full target over a 24-month period. Now, there are 2 standard classes that we offer, and this is true of our term policy as well as our GUL contract. What this offers is a standard, regular standard rate class and also a standard plus rate class. So in other words, you might have a client that you're really hoping to fit into preferred. However, they don't fit to preferred. Well, the good news is they don't have to fall all the way to standard. They can have a standard plus rate class. So we have standard, standard plus, preferred, and preferred plus. And markets that this product works in, generally it's the ones that need coverage, you know, for lifetime. So those would be the ones you see here. Okay, so what about that substantial guaranteed cash value? What does it look like? Well, I encourage you to run an illustration or, you know, get with us. We'll get an illustration for you so you can see what that guaranteed cash value looks like. Here's a little snapshot. This is a client age 55 on the left-hand side, 65 on the right-hand side, and you're looking at how much guaranteed cash value. Again, guaranteed cash value, not projected cash value like in an IUL, guaranteed cash value like a whole life contract. How much is in there after 20, 30, 40, 50, and 60 years. And you can see it really starts to build and substantially builds up until there's a full $1 million of guaranteed cash value at maturity, because this was a $1 million policy. So since it's a $1 million death benefit policy, you can always know that there'll be $1 million of guaranteed cash value at maturity as long as you guarantee the policy all the way to 121. So that's pretty important. If you're trying to provide the client with as much value out of this policy as possible, and they're willing to pay a little more premium to guarantee it for lifetime, that'd be the way to show it. So why does guaranteed cash value matter? I promised to show you why. So here's why. Here's an example. Think about this. You have a client, age 65, qualified for preferred non-tobacco, and it's guaranteed to 121. All right, so here's your situation on the left-hand side. You've got this $1 million policy, guaranteed to 121. Client is paying $20,000, almost $21,000 per year for this contract. Now, after 20 years, client is now 85, and there's a little over $150,000 of guaranteed cash value in the contract. Okay, so here's why the cash matters. Let's say this client calls you and says, you know what, I'd like to reduce my death benefit, and I'd also like to reduce my premium. Usually it's the latter. They want to reduce the premium. Now they're into their retirement. They can't afford that $21,000 anymore, and so they call you and say, what can you do for me? Reduce that premium. Well, here's what we can do. The client can take a withdrawal of guaranteed cash value. Just an example here, but we'll call it 50%. So they take half of the $150,000, which is roughly $75,000, $77,000 to be exact, and they take that money and they put it in their pocket. What's the result of that guaranteed withdrawal? Well, most times in a GUL contract, if you take any of the money out of it, it blows up the policy. So this is really cool the way this works. What we do is we reduce the death benefit and the premium in the same proportion of guaranteed cash value taken out to how much was in there. Well, there was 50% withdrawn, so we reduced the death benefit by 50%. It was $1 million, now it's $500,000. We reduced the premium from the $21,000 down to the $10,500. But the key is that the remaining death benefit, which is $500,000, is still guaranteed to 121. So it didn't blow up the policy. It didn't reduce the guarantee. All it did was proportionally reduce the premium and the death benefit in the same amount of cash value withdrawn. So the cash value is still half in there, right, because they only took half out. So there's $77,000 left in the policy. Annual premium going forward is down to $10,000. Hopefully that meets their budget need going forward. And, you know, the $500,000 are still guaranteed out to 121. And chances are in retirement they may have less need for the death benefit, so they might be okay with having $500,000 now rather than the $1 million. Now, what we just talked about was for the single life GUL, but the same holds true for our survivorship version. So you're going to find that the cash value grows in the same way as long as you guarantee it to maturity. You'll find that there's still that ability to make the adjustments that we just talked about also on the survivorship plan. And there's something that's even better, something that's definitely unique within this survivorship plan. I want to be clear that when I talk about this next feature, it's something that's unique to the survivorship plan. There is something very similar that is available on the single life plan. We'll talk about that in a little bit, but I want to just make sure that when I roll this next slide, you know this is on our survivorship plan only. We offer something that you can just think of it as an ROP, but it's called Enhanced Surrender Value Rider. There's no additional cost to this feature, and what it does is it allows the clients, in this case, you got 2 clients, it's survivorship coverage. After 15 years, there's a 60-day window where they can do a full surrender of the policy, give it back to us here at the company, and we'll send them a check for all the premiums they paid in to that point. It's an incredible deal. I always just kind of relate back to when I buy a car. If I were to go to a lot and the person selling me the car could tell me that after 15 years I could give the car back and they give me my money back, I'd take that deal in a minute. So that's exactly what we're offering here is a return of premium if they do a full surrender, and it's only available for 60 days after the 15th year. Now, the policy has to be funded sufficiently to get this feature added in there at no cost, and what I find is it usually requires a guarantee somewhere beyond age 100, and it depends on the rate classes and the clients how far. It could be to 110. We might get it at age 100, and sometimes it takes going all the way to 121. Good news is when we run the illustration on the Secure Survivor GUL2, you'll see it on the ledger. The amount will be right there listed, so you'll know if it's on there or not. Now, you can also quote this using our Rapid Rater. You can quote the Single Life Secure Lifetime GUL, or you can quote the survivorship version. When you quote the GUL product, all you're getting is a premium quote, right? You're just like the term policies. You're getting a premium quote. Here's how much the client would have to pay if they qualify for that rate class and want the guarantee run for 10, 20, however many years on the term. Here you're getting a guarantee to result. So you might see if it's not too small on your screen, there's 4 options that it'll always show you. Guaranteed to age 90, guaranteed to 95, guaranteed to 100, and guaranteed to 121. And I do recommend, again, that age 121 guarantee because you'll have as much cash value growth in there as possible when you run it to the 121. And you can see the pricing isn't significantly different between these guarantee durations. So if the client's willing to pay that premium for 121, that's the spot where they get the most value. Again, if you'd like to quote this tool, just go out to Google, punch in Rapid, and punch in Rater, and it should be the first item that comes up. So now what do? You found a client, you found a product that works well for them. Well, if the product is one of these protection products and you want to use a very simple way to submit the business to the company, you can use our online application submission tool. It's called AIG Quick Ticket. So what AIG Quick Ticket allows for is some simple short-form data entry, putting the client data in there, and then you can hit submit. And once you've completed all the fields, and I'll show you a few of the fields here, what will happen is it'll actually go through to a third party we use called Exam 1. Exam 1 will then contact your client using the data that you've provided on this online submission tool. They'll usually call within 24 hours and talk to your client, talk to them about their history, get some medical information, and then they'll set an appointment to go out and actually get the exam and also the labs, the urine and the blood, all figured out. So they'll set that appointment with the client at the time that they make the phone call to do the telephone interview. So in this way, you can do your online submission, let Exam 1 handle all of the meeting with the client and data collection, and get the signatures at that time on the application, on all the medical information. Then that flows through to Exam 1, which electronically gets submitted to American General. So this is an online submission option. I do recommend it for our term and also our GUL. And I hope that you'll find it as an efficient way to handle your business and really be able to look out for that next client rather than doing a lot of the fulfillment portion. We can handle that for you. So this is the second screen you'd get to. It would just be the client data, how much they make. There's details in here actually about the policy. This would be how long the policy should last, how much coverage they need, and any other riders you might be interested to add. Then you hit the next button in the lower right-hand corner. It'll take you to this screen where you enter the client data, social security number, details like that are required here. Each field is required. You'll see, and as you move between the fields, you can go to the next screen without completing every last item, but as you get to the end, and here's your client income and also net worth, get to the beneficiary screen, If you have additional beneficiaries, you can add those just by hitting the green Add button. And then you'll choose how they want to pay. Usually monthly draft is a good approach with this because the examiner won't be able to accept any premium when they meet with the client. So doing this monthly bank draft is a great way to do it because it'll allow for binding coverage at the time of the meeting, which is nice because obviously we've got to get through underwriting before it's approved and issued. So it's a bank draft typically with this, but we can handle other options. And finally, the agent's report. So once you get past the last page, you'll get to a part where you have to verify that the information is correct. So once you're done, you thought you were done, right? It says okay, and you get the feeling like you're finished. Don't stop yet. Go ahead and validate the policy. In other words, you want to go complete all the fields, then you want to go to validate. And you can see validate is that green check mark. It lights up green when it's ready to validate. And you have to make sure you validate this to make sure that all the fields have been properly inputted and that the information in those fields is accurate. I've done some submissions before where the zip code was wrong, and the system caught that and brought me back to that field, and I double-checked the zip code, and yes, I had it wrong, so I corrected that, then submitted it again, and it worked. The validation process said okay, thumbs up, and after I got done inputting, then validating, then I submitted. So it's really important you do all three steps. If you miss one of the steps, it will not go through, and you might be thinking that it's all working in the background while it's actually not. So it's really important you kind of slow down towards the end, make sure you do all the steps. And there's the submit button. So once you get done data entering, you get done validating, now you also want to hit the submit button. So that is where we'll stop as far as the systems and also the protection products. However, we've got a lot of accumulation products as well, and so these offer not only protection, but they also offer accumulation. One of the products that does a great job for clients is the Choice Index GUL. This is our hybrid GUL-IUL product. So what it offers a client is guaranteed death benefit protection. We were talking about secure lifetime earlier and it providing lifelong protection. Well, this product does the same, and you can also dial the guarantee to age 100 or 110 or 121. What happens with this product is it also offers index crediting for some upside potential. And that's the beauty of this product. Typically, I find it costs about 15, maybe 20% more than the secure lifetime GUL, but for that additional 15 or 20%, the client, rather than seeing crediting based on sort of a fixed account, they put it into these index crediting accounts so that should these indexes perform well, then the cash value will also grow. Also very nice with this policy is that there's a crediting floor, so there's a nice guaranteed floor of 1%. So we always know that crediting in these contracts, even if the performance of the index is poor and negative for some reason, there will always be positive growth within the cash value in this policy because of the 1% floor on it. So let's take a look at some of the details. You can dial the guarantee, as I mentioned. You can do a short pay, you can do a full pay, just like you could with secure lifetime. So if they want to pay to age 65, but guarantee the coverage out to 100 or 121, we can set it up that way. It also has 24-month rolling targets, except New York. New York doesn't have rolling targets. That's a law in New York. So here's the index crediting options. When you look at the design of this AIG Choice Index GUL, this offers you a declared interest account. That'll make it operate a lot like our regular secure lifetime GUL. But usually people, when they choose this product, they're looking for one of these index crediting strategies. The first index crediting strategy is the 1-year index account. The second one is the 5-year index account. The 1-year account is very straightforward. I think of this as the Honda Accord option. It works great. It's reliable. It's durable. It's also very easy to run, so it doesn't require a lot of maintenance or explanation. It's simple. It's a 1-year point-to-point, so it'll work like any other 1-year point-to-point out there where crediting occurs on an annual basis. And it's linked to the performance of the S&P 500 index only, so it's just S&P. It's a domestic index. Now this has a cap and it has a floor, so we know that the performance of the S&P 500 is going to drive the accumulation of the policy subject to the cap, so it can't be any higher than the cap. So if the S&P returns, 30%, then crediting the policy will be the cap, which is 11%. But if the S&P goes down 30%, then the crediting of the policy will be this 1%, because that's the guaranteed rate. The current maximum illustrative rate, so the most you can show on this product right now using the 1-year count, is 7.16. And that's a number we come up with using our cap of 11%, our floor of 1%, and how well the S&P 500 has performed over the last 20 years. So it's a fairly conservative estimate, 7.16. But if you like some other number, call it 6%, you'll actually always see an alternate ledger in the illustration showing 6%. But you can ask for another number too. Maybe you want to show 4% just to be a little more conservative. You can do that. Now let's talk about that 5-year index account. This is what makes this product really unique. And I think for a lot of younger people out there, this makes great sense. They have a long time horizon. They might be in their 40s, and they don't plan on using the cash value in this policy until their retirement years, so they may have 20-some-odd years to let this accumulate. Well, if that's the case, I highly recommend this 5-year point-to-point. The 5-year index works like this. It is going to be crediting. It's a crediting strategy that credits the policy based on a very unique calculation, and the calculation is based on a 3 global index strategy. So we have the S&P 500 here in the U.S., we have the Eurostoxx 50 in the Eurozone, and we have the Hang Seng, which is over in Hong Kong. So we've got these 3 global indices, and what we do is we wait 5 years, which is why it's a 5-year point-to-point. Wait 5 years and then see how the performance of those 3 indices was over that 5-year period. So the client has to have the willingness, the patience to wait 5 years before we're going to credit the policy. And if they are willing to wait the 5 years, then they get the benefit of this strategy, which is this. After the 5 years is up, we look at those 3 global indices and we see which one performed best. Then we credit that policy and we overweight at a 75% clip to that top performer. Then we look at the second best performer and we overweight that at 25%. And whichever of the 3 indices did worst, and it's been the Eurozone recently, we throw it out of the mix altogether, and that's a big advantage. So we do the 75-25-0 overweighting, and we also apply what's called a participation rate. So there is no cap when you're using the 5-year point-to-point. Whereas in the 1 year there was 11% cap, there's no cap with a 5-year point-to-point because we're just using a participation rate. So as we look at the performance of these indices, then we do that calculation of the 75-25-0, and then what we'll need to do is apply the participation rate, which is 70%. And that basically is something we do in the background, but it is important to know that that rate is 70%, and that rate, of course, can move, just like the caps can move as well. But that 70% is very generous, and what you can see is that the current maximum illustrative rate using this overweighting strategy in the 3 global indices is 9.65. So you can show a very nice high 9.65 growth rate when you're running the Choice Index GUL using the 5-year point-to-point. So rather than going a whole lot further than that, hopefully that gives a little bit of a of a summary of how that 5-year point-to-point option works. It's very unique to American General, and it's available to you. If some clients feel like they want access to the global economy, then this option might be very good for them. If they choose that they'd like to have annual crediting, then the 1-year point-to-point would be better for them. And if you feel like a client might be in need of a mix of the 2, you could put 50% of the premium into the 1 year and 50% into the 5-year, and that's a strategy that a lot of people like as well. Let's talk about one other product, and then we'll wrap up and we'll see if there's some questions about this. So I appreciate your patience and your attention. The Elite Index is the other product I'd like to show you. This product is actually very close to the 1-year point-to-point in the Choice, so I don't think this will take a whole lot of explanation. It's our straightforward IUL product, and when I say straightforward IUL, pure IUL, I mean it's not a hybrid. There's no GUL function to this. So this is for a client who isn't as concerned about the guaranteed protection at all. They're really looking to maximize the potential accumulation and use this more than anything as a way to create distributions into retirement. What I like about this product is it's very lean design, very simple. It's just a 1-year point-to-point, so there's no 5-year point-to-point option here. And it's got two options still, and I'll show you those two options. There's a cap account and there's a participation account. But what's really neat about this product is it has incredibly low costs associated with it. So if you're looking for a low-cost option on IUL, this is the one. And it also goes down to a face amount of $50,000, while other products really bottom out at $100,000. So if a client is really looking for a smaller policy, this Elite Index is the one. And oftentimes, if you're looking for accumulation, you want to get the death benefit as possible so that more of the premium dollars that you're putting in are going towards the cash value rather than towards supporting the death benefit. So this is a great product, you know, if the idea is accumulation. But again, the two options you have, both are 1-year point-to-point. The 1-year point-to-point cap option looks a lot like that 1-year point-to-point on the choice. The cap is a little bit lower. It's a 10% cap. It's got the 1% guarantee, and the max illustrative rate is 6.68, just based on the S&P 500. The other option is the 1-year participation rate. So this is the 1-year point-to-point that's par. And the way it works is it's linked to the S&P 500, again, just 1-year annual point-to-point. And what it offers is no cap, but it's got a participation rate. So it's got a 60% participation rate. One other neat thing about the PAR account is it's got a 2% minimum annual guarantee. So if you have a client that is looking for IUL upside, but it would really like to know that there would be a guaranteed crediting and a strong guaranteed crediting option, the participation account offers that 2% guarantee, which is really nice. And it also allows for showing a little bit higher rate, which is 7.74, just based on our 20-year look back, using the 60% participation rate and using the S&P 500 performance. A couple of the other benefits there for Elite Index, and really for our UL products in general. This is kind of an underwriting item, but I'll mention this. We use something called expanded standard. So if you have a client that really would qualify for Table B rates, they're just outside of standard, we pull them straight into standard on our UL business, call it Secure Lifetime Choice Index or Elite Index. As long as they qualify for that Table 2, we pull them straight up to standard, and we do that on UL business, as mentioned, up through age 70. And that really brings us to a wrap. So I will go ahead and pass it back to you, Mike.
Thanks, Tor. That was excellent. I think you really hit on some good points on all these products, and you know, and also the sales tools. And I just want to make a comment about the sales tools. I have used the Rapid Rater and the Quick Ticket. I found it's just a great way to sit down with somebody, really anywhere. I mean, if you have a computer and you have an internet connection, you can sit down, you can show them, you know, the rates. And you can take an application right there, and it's really simple, and it's actually really fast to do it that way if you're sitting with somebody. So I'm just thinking for internal consumption purposes, you can sit down with you know, a new team member, sit down with them in the hotel or wherever you are in your office or in a coffee shop, show them like return to premium, term premiums, show them how it looks like, because you can illustrate that on the Rapid Rater, and then just take an application right there. So I see this as a very useful tool for everybody. Randy, do you have any questions?
No, Mike, that was a great comment. I'm glad you brought it around to internal consumption, using that as a tool, because that is perfect to do that and use these tools to make sure that your people are trained on them. I thought that was perfect.
All right. Well, I think with that, we'll wrap up. Tor, really appreciate you being on the call today, and we'll have you on again sometime. Thank you. Thanks,
I look forward to it.